Welcome and thank you for joining us. This video covers the IASB's proposals about improving disclosures about business combinations. I'm Dehao Fang, and I'm joined by Nick and Bertrand today.
Hello, I'm Nick Anderson. I'm an IASB member and I have an investor background.
Hello, I'm Bertrand Perrin. I'm an IASB member and I have a preparer background.
The objective of the project is to improve information entities provide about business combinations at a reasonable cost. Acquisitions are referred to as business combinations in IFRS accounting standards. We use these terms interchangeably. In 2020, the IASB published a discussion paper on this project that analyzed the feedback and redeliberated to reach a package of proposals. The IASB published an exposure draft with these proposals, which is open for comment until 15 July. The two main areas of the exposure draft are the disclosure requirements in IFRS 3 and the impairment test in IAS 36, which form a package of proposals. In this video, we are discussing the disclosure requirements in IFRS 3. For more background on the project, watch our introductory video. There's also a separate video with information about the impairment test in IAS 36, which you can refer to. We'll focus on three aspects of the proposed changes to IFRS 3 in this slide. But before we take a closer look at the proposed disclosure changes to IFRS 3, let me first turn to Nick and Bertrand to ask how the proposals strike a balance between the benefits of the information and the cost of disclosing them. Nick, let's start with you first.
Thanks, Dehao. Investors said that this information is needed. It helps them assess management stewardship of the entity's resources, in particular how good management are at capital allocation. It can help investors evaluate whether a business combination is a success, replacing information that may have been obtained from the impairment test. These are the benefits of the proposals. Bertrand, over to you.
Thank you, Dehao and Nick. Preparers have told us that they have some concerns about disclosing this information. The most common concern from preparers is that some of the information would be so commercially sensitive that they shouldn't be required to disclose it. Moreover, disclosing such information in financial statements could lead to additional litigation risks.
Thanks, Nick and Bertrand. So now let's start looking at the main proposed disclosure requirements for IFRS 3, that is, information about performance of a business combination. This slide shows the overall requirements. In the year of acquisition, the acquirer will be required to disclose all the key objectives and targets for a business combination. Then in subsequent years, it will disclose the actual performance against those key objectives and targets. As we mentioned, the IASB is trying to get the right balance between costs and benefits. So it's only proposing that entities would disclose the information for what it called strategic business combination. Nick to explain what this means later. And Bertrand will explain the exemption, which applies to some items of commercially sensitive information. But before we hear from them, I'll go into detail on what information will be disclosed. The proposed disclosures about the performance of business combination will follow a management approach. This approach dictates what information an entity discloses and how long the information will be disclosed for. One example of a target could be increasing the market share of an entity's North American business to 20% by 2030. The disclosures for subsequent performance would then include the actual performance and a statement of whether the performance is meeting the target. In terms of identifying the information, the IASB decided to require an entity to disclose what its key management personnel is reviewing. Key management personnel here is a term that many stakeholders are familiar with from its use in IAS 24, the related party standard. It is also used to identify what information an entity discloses in other standards. For example, IFRS 7 financial instrument disclosures. The IASB expects that key management personnel are a senior level of management. As senior management in an entity, the IASB expects that key management personnel will be interested only in the most important information about the most important acquisitions. Using this senior level of management helps identify information that the IASB expects to be of most interest to investors. Moving on to the right-hand side of the slide, applying these proposals, an entity will be required to disclose information about performance of a business combination for as long as key management personnel review that information. In this context, reviewing means comparing actual performance to the acquisition date, key objectives, and related targets. The IASB plans to add some additional requirements on top of that basic period. These requirements cover situations in which key management personnel don't start monitoring the achievement of key objectives and related target, or stop performing that review before the end of the second year after the year of acquisition. This information will be helpful to investors in assessing management stewardship of an entity's resources. Investors said they would be interested in knowing if senior management don't review what could be large transactions for an entity. Nick, over to you to discuss how entities will identify strategic business combinations.
The IASB is trying to identify a population of business combinations that is smaller than the population of business combinations entities are already required to disclose information about applying IFRS 3. The purpose of this proposal is to reduce the number of business combinations, only capturing those that are most important to investors and therefore reducing the cost of applying the proposals. In the discussion paper, the IASB considered looking at what information the entity's Chief Operating Decision Maker, or CODM, reviews. Specifically, the discussion paper suggested requiring entities to disclose information about all the business combinations reviewed by the CODM. However, feedback on this idea was mixed. Some respondents highlighted that there is diversity in what business combinations CODMs look at in different entities. Instead, to identify the relevant business combinations, the IASB is proposing to use thresholds, both quantitative and qualitative thresholds. The quantitative thresholds are based on thresholds used by regulators to identify business combinations they require entities to provide information about or require a shareholder vote. Regulators have thresholds based on financial statement line items like profit and loss and other items like market capitalization. The IASB decided to focus on thresholds based on financial statement line items to avoid having to define new terms. We're using a mixture of different line items to cater for different reasons for entering into a business combination. The IASB proposed setting the thresholds at 10%. We accept this to some extent is arbitrary, but the percentage is within the range currently used by some regulators. It is also the figure used in IFRS 8 to identify how to aggregate segments. The qualitative thresholds are proposed to capture business combinations that might be important to an entity but not large in size. The IASB based this threshold on that used in IFRS 5 to identify discontinued operations. The wording is updated to reflect purchases rather than sales. We are seeking feedback from stakeholders to whether the IASB has identified the right thresholds. Therefore, we're interested in hearing whether the thresholds identify a population of business combinations similar to the population of business combinations information is disclosed about applying IFRS 3 today, and whether the thresholds identify the appropriate population, that is, all the most important business combinations, but no more than that.
Thank you, Nick. I'll now discuss expected synergies. IFRS 3 already requires an entity to disclose qualitative information about the factors that make up the acquisition price and the goodwill, and synergies is an example. These proposals build on the existing requirement to require quantitative information. The IASB heard feedback from investors that they need better information about expected synergies. The proposals will require an entity to specify the different categories of expected synergies from the acquisition. For example, revenue synergies, cost synergies, tax synergies, etc. For each category of synergies, the proposal will require an entity to disclose the amount of expected synergies, the expected cost to achieve those synergies, and the time frame over which the benefits from those synergies are expected to accrue to the entity. The quantitative figures for synergies could be disclosed either as a point estimate or as a range. The disclosure of expected synergies is only required in the year of acquisition, so entities typically wouldn't need to disclose whether the synergies are actually achieved in the future. Entities will only need to disclose the achievement of synergies if the disclosure on performance of a business combination that we have just explained earlier applies, because management's key objective for the acquisition was to achieve those synergies. The acquisition date disclosure about expected synergies would be required for all material business combinations and not just strategic business combinations. That is, the same population as existing disclosure requirements in IFRS 3 will apply. There is an exemption that applies to both the proposed disclosures about performance of a business combination and the expected synergies. And I'll now pass on to Bertrand to explain about this exemption.
Thank you, Dehao. I'll explain what the exemption is first. Then on the next slide, Dehao will explain exactly which disclosures it can be applied to. It's the same exemption for all of the new disclosures we've talked about so far, that being the disclosures about performance of a business combination and disclosures about expected synergies. The IASB developed the proposed exemption after extensive outreach, particularly with preparers and users, but also other stakeholders. The IASB has designed the exemption so that it can be applied in circumstances when it is needed, but was also cautious of concerns from users, regulators, and auditors that the exemption needs to be enforceable and applied only when it is appropriate. The design of the exemption is aimed at responding to preparers' concerns about the potential commercial sensitivity of information. Its design might also respond to some concerns about forward-looking information. For example, if litigation would arise because of the information being disclosed. But it would not respond to the risk of litigation from other sources. For instance, if performance wasn't as expected. There is a principle for the exemption, that an entity be exempt from disclosing information if disclosing it can be expected to seriously prejudice the achievement of a key objective for the business combination. This is based on the wording of a similar exemption in IAS 37. The IASB is also proposing application guidance. This builds on requirements the IASB has observed in similar exemptions that exist in various exemptions already enforced by some regulators. The application guidance includes factors an entity needs to consider when determining whether it is appropriate to apply the exemption to an item of information. For example, if an entity has already made information public in another document, like an investor presentation, then the information is not considered commercially sensitive. Therefore, entities will keep assessing whether they are eligible for the exemption. We encourage viewers to read the wording in the exposure draft. The IASB is keen to hear from stakeholders whether the exemption can be applied in the circumstances preparers need it, and whether auditors and regulators think there are sufficient requirements to restrict the use of the exemptions only to the circumstances it is to be used for.
Thanks, Bertrand. This slide here summarizes what we have talked about so far and indicates that the exemption cannot be applied to strategic rationale for an acquisition, which we'll explain later, and the actual performance of the acquisition. Next, we'll delve into a few other aspects of the proposals on which questions are often asked. Bertrand will talk about the location of information. I will talk about how the requirements will apply if the acquired business is quickly integrated with the acquirer's business and the auditability of the information. And Nick will discuss other proposed requirements. Over to you, Bertrand.
Thanks, Dehao. Regarding the location of the information, respondents to the discussion paper questioned whether information about the performance of a business combination and expected synergies should be included in financial statements or in another document, for example, management commentary. Some respondents said that the information is not directly related to an entity's assets and liabilities. However, this information explains the price the entity paid for the business combination. That price is reflected in the value of the assets and liabilities recognized on acquisition, particularly goodwill. For example, IFRS 3 already requires an entity to disclose qualitative information about expected synergies, highlighting the link between synergy information and goodwill. Other respondents said the information is forward-looking and so does not belong in the financial statements. However, some IASB members consider information about objectives, targets, and synergies not to be forward-looking. This is because that information is the assumptions that underpin the price paid for the business combination. The business combinations reported in the financial statements is a past transaction, not a future transaction. The IASB also considered its position even if the information were forward-looking. The conceptual framework sets conditions for whether to include forward-looking information in financial statements. These conditions are that the information is related to an entity's assets, liabilities, income, or expenses, and that the information is useful to investors. The IASB notes that the information meets both these conditions. Therefore, the IASB concluded that information about the performance of a business combination and synergies can be required in financial statements.
Thanks, Bertrand. And on integration, respondents often noted that the acquired businesses are quickly integrated into an existing business and that an entity's management does not track the acquired business separately. The proposals would not require an entity to track the performance of an acquired business in isolation. The management approach is flexible and focuses on how management will assess the outcome of the business combination rather than the acquired business specifically. An entity will be required only to disclose what information its key management personnel is using to assess the performance of a business combination. An entity might assess the achievement of its key objectives for a business combination using information about a combined business, like revenue for a cash-generating unit, into which the acquired business is integrated. If so, the information the entity is required to disclose will be the information about this cash-generating unit. If management do not assess the achievement of a key objectives at all because of integration, then it would simply have to disclose that fact. Regarding auditability, some stakeholders question whether the information would be auditable, particularly information about targets measured using a non-currency measurement unit. We consulted with auditors on this question, and most auditors said that the information will be auditable at an extra cost. The IASB considered this cost in assessing whether the benefits of the proposal will outweigh the cost. The IASB is not expecting an auditor to opine on whether the objective and target for a business combination are appropriate. We expect that an auditor will be able to confirm that information disclosed is the information that was reviewed by entity's key management personnel, and that the entity has adequately explained how that information was prepared. Next, I will pass on to Nick to discuss other proposed amendments.
So far, we've focused on the two most significant disclosure changes about the performance of a business combination and expected synergies. There are a few smaller amendments that I'd quickly like to explain on the next two slides. On disclosure objectives, the IASB is proposing to add a new disclosure objective to IFRS 3. The disclosure objective has been designed to meet the information needs of investors, information investors say they need but do not currently receive. On strategic rationale, this is a replacement for an existing requirement to disclose the primary reasons for the business combination. The idea is to require an entity to provide information that links the entity's overall business strategy with the objectives for the business combination. On combined entity information, IFRS 3 already requires an entity to disclose information about the contribution of a business combination, including information about what the revenue and profit for the entity would have been if all business combinations had been undertaken from the beginning of the reporting period. This is sometimes called pro forma information. We decided to retain this requirement. Although some preparers said it was costly to prepare, investors highlighted the information as one that had high value to them. The IASB is proposing to specify that the profit figure discloses operating profit or loss as defined in IFRS 18. This reduces diversity in terms of what type of profit entities disclose. Operating profit also means that entities will not need to make estimates of the effect on financing income and expenses, one source of cost some entities incur trying to applying today's requirement. Stakeholders said we should provide guidance on how to calculate combined entity information. For example, what to do with transactions between the entity and the acquired business before the acquisition date. The IASB decided it was not possible to provide application guidance for all situations entities might have questions about. However, we're proposing to explain what the requirement is for, what we will give a framework for the entity to make judgments to calculate this information. The IASB is also specifying this as an accounting policy, and so to the extent the information is material, an entity will be required to disclose how it's being prepared. For defined benefits and financing liabilities, some investors told the IASB they considered these liabilities to be part of the capital employed in a business combination, but that some entities do not disclose this information in the financial statements. IFRS 3 already requires information about assets acquired and liabilities assumed. Taking a principle-based approach, the IASB has not specifically requested separate disclosure of pension and financing liabilities. Instead, the IASB proposes to add these items to the illustrative examples in IFRS 3 to highlight more clearly the need for this information.
Thanks, Nick and Bertrand. That concludes this video. Remember, you can also watch our introductory video and our video on the changes to the impairment test, and this will be available on our website. We look forward to hearing your comments. Thank you.